Hey, good afternoon, everybody. I'm David Silver, CEO of Instrumental Wealth, and want to thank everybody for joining us this afternoon to discuss a very spicy topic for many, but certainly one that we're excited to share some details with everybody on. As far as our guests here today, we've got Matt Harbert, our Chief Investment Officer for Instrumental Wealth, and Drew Allen, Senior Wealth Advisor at Instrumental Wealth. And we want to jump right into it because there's a lot of content here. As far as the outline, we're going to break this down into a couple of different sections. The first, Drew and I are going to tackle the economy and policy decisions, and then we're going to turn it over to Matt to get through a lot of details around the markets. And while this is a spicy topic for a lot of people, and while there's a lot of emotions and opinions on this matter, a couple disclaimers here. We're not here to share our opinions, but really debunk some of the myths around presidential election cycles and how they can affect markets and the economy, as well as address some concerns that we hear often from clients. About every 4 years, the same questions come up. And while we've been through these cycles many times in our careers, we want to address some of those concerns and questions that get brought up. And as always, this is not intended to be investment advice, but rather educational in nature. So, Drew, let me go ahead and turn it over to you, and we'll jump right into things.
Yeah, great. Thanks, Dave. So look forward to spending time with everybody on the webinar today. Thanks for joining, taking time out of your day. So we're going to start with the economy and policy, and we're going to cover the current economics and political landscapes. Inside that, we're going to specifically talk through the overview of where we've been in the 2024 election cycle and where we're at, potential policy changes and their economic implications, as well as some key economic indicators and some of the challenges associated with those. So moving into where we're at in the election timeline. So as you can see, everybody on the webinar is probably aware, back in January, we started in the primary season, and we're well underway, and it's already delivered a host of surprises and unexpected twists and turns. Former President Trump officially secured the Republican nomination at the Republican National Convention, and then announced Senator J.D. Vance of Ohio as his vice presidential running mate. A few days later, President Biden then withdrew from the race, and the Democratic Party was really left with the challenge of confirming a new nominee for the election, with just a few months before the date of the election, which is November 5th. So currently, right now, we're in the section of that September-October presidential debate season, which starts next week. We're going to see the first presidential debate on September 10th here as we move through this, and then well into Election Day. So it should be a lot going on between now and November 5th. So what we're looking at here is really a battle for Congress and the presidential White House. So what we've seen is, and we know that there's 538 electoral college votes available, and 270 are required to win the presidency. In 2020, President Biden earned 306 of those votes. Former President Trump earned 232. So for President Trump to relative to his 2020 election, we'd have to pick up 38 votes to win the presidency. As we move to the Senate, currently is 48 Democrats, 49 Republicans, and 3 independents. Those independents have historically voted Democratic, so the Republicans really would need to pick up 2 seats to control the Senate, or possibly 1 if a Republican President Trump wins the presidency, with the VP being the tiebreaker there. So the House of Representatives is also a very, very tight, close race as well. Republicans currently do control the House, and the Democrats would need 5 seats to take control. And so we'll learn a little bit more about what does that mean for the markets, and depending on which way all these go in these election seasons. So in getting into some of the policies and proposals. So On the left-hand side, you'll see down underneath what looks like the White House there, just different areas here between taxes, trade, immigration, all the way down to regulation, and then each political party's potential stance on these areas, all the way down through things such as the taxes, immigration, and government regulation, all hot topic. But looking ahead, the biggest risk is likely a lack of fiscal conservatism from either candidate, which could lead to further deterioration of the U.S. federal finances and our debt, which we'll talk a little bit more about in the coming minutes. So as a result, higher taxes potentially could be in store to offset some of that debt burden, to reduce that stress on the economics of the country. So moreover, despite a lot of campaign rhetoric, either administration will likely be constrained by congressional approval in many of these key policy areas that they will have to work through and work with Congress to accomplish. As we look at one of the major key issues is taxation. And in 2017, the Tax Cuts and Jobs Act was put into place starting in 2018, and that is set to expire. And so without the urgency of a recession or a pandemic to address, it's unlikely the next administration will champion major fiscal spending plans. But however, many of the provisions are set to expire. So whoever gets elected to the White House will have a chance to possibly reset some tax policy. And so when we think about that, in the two kind of viewpoints here, a Republican administration would likely try to make the expiring income tax provisions more permanent, tax large private university endowments, and impose new tariffs on all U.S. imports. The Democratic administration would most likely also extend some of the provisions on income taxes while tightening the estate tax rules. And during his campaign, although he's no longer the presidential candidate, President Biden suggested he would support a tax increase on folks making more than $400,000 a year, and potentially adding an unrealized capital gain tax. It remains to be seen what Vice President Harris will put forth as key fiscal policy changes, or will she continue carrying forward some of President Biden's tax plans as he had suggested in his campaign. So having gone through that, we want to shift a bit here to some of the key economic indicators. And Dave, why don't you jump into that and let's walk through that.
Yeah, happy to. Thanks, Drew. That was really great to break that down. So this is a really busy slide, and I'm going to start off by explaining to everybody what we're looking at here. I'm going to actually start off in the upper right-hand part of this slide, which is a chart that is showing the federal deficit compared to the net interest expense. On the vertical axis is the percentage to GDP, and on the horizontal axis, you'll see the calendar year. What's important to point out here in the upper right, where it shows the vertical dotted line, is where we're at currently in 2024. Based upon the forecast, which you'll see there in the red lines, is if the Tax Cut and Job Act gets extended, to Drew's point, if President Trump wins and has control over both houses of Congress, both chambers of Congress, then that is projected to actually expand based on the tax cuts, or what it commonly is referred to as the Trump tax cuts. If things revert back to the previous administration, that percentage is projected to go down a little bit. But the reality is it's still a negative number. And I think, to Drew's point, there'll be constraints here with what political party, whoever it may be that's in power, can really do here. On the chart right below this is the national debt as a percentage of GDP. And this gets a lot of headlines, rightfully so, right? This is a concerning chart for seeing the debt grow, but certainly as a percentage of GDP. What you'll see there again is in the red line, the Trump tax cuts, or the tax Cuts and Job Act extension would further extend that percentage. And if we revert back to the previous administration's tax policy, then it will still be an increase, but just not as significant. On the left side of the chart is one of my favorite visuals to look at from just understanding the federal budget. Depending on what media source you subscribe to, you may hear different views on this, but the point of this chart is to really just give you a visual of the federal budget as to how it's broken down. And on the bottom right side of this chart, you'll see the tax receipts, which come in through the corporate tax there in blue, which represents about $525 billion of revenues to the Treasury come in through the corporate tax. The income tax represents about $2.5 trillion as far as the overall tax receipts are concerned. You'll see what comes in green below that, about 25% through Social Security tax. And then the deficit spending right now, which is approaching $2 trillion per year. It's about 1.9 trillion to be exact, in the sort of white box. On the left is how the budget's actually broken down between Medicare and Medicaid spending, Social Security, defense spending, discretionary spending, the interest on the debt, which continues to be top of mind here, which is approaching about $1 trillion a year as well. And so I think the point of this is to really just look at this from the perspective that there are budget deficits. And I think that regardless of who's in power, that the ultimate side of this is that I think the deficit will be front and center for whoever has to deal with the leadership, and will likely be reflected in a lot of their policies. I think some of the extremes by both parties, it's going to be hard, I think, for either one to have some of those extreme measures that have been proposed due to how tight of a race it's going to be for congressional seats. On the next slide, I actually want to talk through where we're at from the economy. And I think that on the top part of this slide, I'll explain this because this can be a little bit confusing without a little bit of explanation up top, which is, where we're at from an economic perspective. These are from our partners over at Fidelity. And what you're looking at on the top slide here is a breakdown as to what the forecast is as to where we are at from an economic cycle perspective. So if you're looking at this, you'll see 3 dots between Q1, Q2, and Q3. What is hidden here behind Q1 is actually Q4 of 2023. So you probably are looking at the legend below saying, where is Q4 of 2023? It's actually hidden behind the Q1 of 2024. What we observed over the last couple of years is this whole notion of whether the economy was going to hit a hard landing or a soft landing. And that has been sort of front and center in the financial press for the better half of about 1.5 years, 2 years, as the Fed has aggressively raised interest rates, causing concern as to what could potentially happen to the economy. And of course, we saw the market volatility in 2022. Those forecasts have been moved backwards. And what you'll see there is the Q1 prediction was that we were late stage heading towards contraction. And as the economic data has come out throughout the first and second quarter of this year, the economists at Fidelity have moved back their forecast. While it's still sort of end of the mid cycle into the late cycle of the economy, we are still somewhere in the sort of late part of this, whether it's late or mid-late, I guess, is based on this chart, TBD. I think the important piece is that while being precise isn't the intent of this chart, but more accurately to depict where we're at. We have a joke around economists. They're a lot like the weathermen, that we know the storm's going to hit Florida. We don't know exactly where, though. And so that being said, I think it is important to understand where we're at from an economic cycle. Below this, on the bottom chart, are really where we see the world, both developed and major economies in the emerging markets economic cycle. You'll see the U.S. Down there below in the light blue. Japan, Australia, Korea are further ahead than Japan. Eurozone and UK even further. Canada is close to contraction and recession, and China's already in recession. And so the world economy is mid to late cycle from a global economic perspective. On the next slide, what I really want to make a point to here is this is where the U.S. Federal Reserve tax receipts are, or the Treasury tax receipts have been at historically. And in the backdrop of where we're at today and the potential for an economic slowdown, I want to point to the last major pullback that we saw here in this chart, which is highlighted in gray on the right-hand side, middle to right-hand side of this chart. And you'll see the global financial crisis of 2007 through 2009. And you'll see the tax receipts to the Treasury really decreased quite a bit. And of course, you'll see different timeframes between COVID and some of the other pullbacks that we've seen there. And the point of the slide is just to point out that if we do continue to go into a mid to late cycle or even recession over the next 4 years, that this will have an impact on policy, as the revenues that the government receives will likely go down on the backdrop of probably an increase of stimulus and government spending that tends to occur during periods of economic slowdown. So that's the update on the economy. Matt, I'm actually going to turn this over to you. And I think the fun stuff, which is markets and what we can sort of glean from the past with markets and the effect of a presidential election.
Thank you, David. Well, it's that time again where investors are curious about how markets will react to election results. So we're going to look at a few things, how markets have historically performed during election years, long-term market trends across different administrations, how different government makeups impact market returns, and how different asset classes performed under the previous two presidents. So starting with historical market performance, we're going to look at election years versus non-election years. On this slide, you'll see the left chart shows returns, and the right chart shows volatility. And the dark blue bars, those are election years going back to 1932 for the S&P 500, and the gray bars are non-election years, also going back to 1932 for the S&P 500. And we'll get to the light blue bars in a moment. But one thing we can see by looking at this is on the left chart, we see that returns have typically been lower during election years. And on the right, we can see volatility has typically been higher during election years. And that does actually make sense, as elections cause additional uncertainty. However, these averages don't necessarily tell the full story, as some presidential election years have been particularly impacted by historical market events. And that's going to get us to the light blue bars that we're looking at. For example, in the year 2000, that sell-off was a result of the bursting of the tech bubble. And in 2008, the markets are hit with the global financial crisis. And finally, in 2020, we had the onset of the pandemic, where markets early on went through a sharp correction, which was then followed by a strong rebound through the rest of the year. And notably, none of these were related to the election itself. And markets actually don't like uncertainty, and we can see this looking through the election year. So this chart shows average returns of election years compared to all the other years throughout the year. And the orange bars are showing election years, the yellow bars are non-election years, and this is broken out per quarter throughout the year. So looking at the orange bars particularly, you can see through the first and second quarter, markets really tended to perform lower. However, as we move through the year and we get more clarity on different candidates' policies and who the potential winner may be, performance does significantly improve. And you can really see that in the third quarter, as on average election years jumped up from about 1.5% over the first two quarters to 6.2% in that third quarter. Now, while the fourth quarter does still lag non-election years slightly, it's still got a pretty robust return at the end of the year. Now, additionally, after Election Day, that source of uncertainty is actually further cleared up. So in this chart, this is a fairly busy chart, so I'll try to make it a little bit more understandable, but this is really showing, if you look at the vertical dotted line, that is the election day. And to the left of that line is the 100 days prior to election day. And to the right of that line is the following 100 days post-election. Now, the squiggly lines that you see all over here, each one of those is it represents one of the election years going back to 1980. And you can see in just about all of the cases, once election day hits and that uncertainty gets cleared up, you can see over the following 100 days that just about all of those post-election years have been positive. The two notable exceptions are actually two of the years we already talked about. The light blue line, which is the election year of 2000, when the tech bubble burst, and the orange line, which is 2008 with the onset of the financial crisis. Now, the important thing to understand here is really, regardless of the election results, markets are going to move on and focus on the fundamentals and not who is in office. Now, what has the long-term trend been for markets and elections? So this chart goes all the way back to JFK's presidency back in 1961 and shows the returns of the S&P 500 since then. Each of the colored areas in here represent each of the president's term in office. And really what's notable here is that there's only been two presidencies all the way back to 1961 that actually had negative returns for the S&P 500. And that was Richard Nixon and George W. Bush. So over the long term, the S&P 500 has consistently grown in value no matter who's in office. But how does the overall makeup of government impact market returns? So this chart, which goes back to 1950, shows average annualized returns for the S&P 500. And on the left side of the chart, it shows all those periods where a Democrat was president. And on the right side shows all of those periods where the Republican was president. And the blue bar indicates times where Democrats had complete control of Congress, The red bar is where Republicans had complete control of Congress, and the striped bar is where Congress was divided between the two parties. Now, what you can see is that regardless of which party holds the presidency, actually the highest returns have occurred whenever Congress was divided. Further, lowest returns are when the Democrats held a majority in Congress, and splitting the two right in the middle is when Republicans had control in both of Congress. In any case, what this really shows, the market has historically been positive, no matter what the composition of government has been. So it is interesting to see how different markets performed under the last two presidencies, as policies will probably be very similar regardless who wins the next election. Now, note that while Biden has pulled out of the election, Kamala's policies will likely be very similar to those that we saw under Biden. And in this slide, the table on the left shows different asset class returns over the time Trump was in office, and the table on the right shows those asset classes and their returns when Biden was in office. So interestingly, equities have performed well in either administration's time in office, with the exception of emerging markets, which you can see in purple, and they were actually increased 72% while Trump was in office, but was the worst performing asset class for Biden, and fell 18% through the first quarter of 24 under Biden. Bond indexes, which you can see in the red, in the blue, and the orange rows, muni bonds, aggregate bonds, and U.S. Treasuries, they actually all increased while Trump was in office, yet they all decreased while Biden was in office. Now, that the important thing to note here is that really was a factor more of interest rate policy. So while Biden was in office, bond prices were hit really heavy by the Fed's aggressive interest rate hikes, less so any of the policies that came across from Biden. Commodities finally were the only actual negative asset class under Trump, but were the top performing asset class for Biden. But again, this was less about policy and more about macro forces, as this was heavily impacted as we emerged from quarantine, and the war in Ukraine really drove supply and demand imbalances for oil and other commodities while Biden was in office. So overall, what the market history tells us is that equity markets really are indifferent to the party that are in office. It's macro forces that impacted prices and returns, not politics. And finally, markets have done best when government is divided. So next, what we're going to talk about is just some common investor misconceptions. The first one is that markets prefer one party over another, and that opinion of which party the market prefers is often determined by party preference. For example, if you're a Republican, you generally are going to assume that the markets are going to do better when a Republican holds office. If you're a Democrat, you assume that markets do better when Democrats are in office. So if we actually look at the upper right chart on here, we can see actual results, and the top, so the first row gives us annualized returns if you had a portfolio and you invested only during times that Republicans were in office, and you moved into cash anytime a Democrat was in office, going all the way back to 1950, you would have had a 2.8% annualized return. On the other hand, if you had invested only during Democratic presidencies and moved to cash anytime a Republican was in office, also going back to 1950, you would have had an annualized return of 5.11%. However, if you had just remained invested the entire time going back to 1950, your portfolio would have had an annual return significantly higher of 8.05%. Now, the bottom left chart really depicts this in dollar terms. So in this case, if you had invested $10,000 back in 1950, and you only invested in when Republicans were in office, and that's the red line, your $10,000 would have grown to about $77,700. Now, if you had invested only during that $10,000 only during times that Democrats were in office, which is the blue line, your $10,000 would have grown to $405,000. Now, finally, if you had just remained invested the entire time, your $10,000 would have grown to a whopping $3.15 million. So what you can see is that making your investment decisions based on a president's political party really would have likely hurt your portfolio. And regardless of the party, staying invested really is the most prudent long-term strategy. Now, finally, another common misconception is that you can use the president's policies to predict performance of various markets or sectors that are out there. Now, we can look at the energy sector to see how challenging this actually is. So, for example, Biden, he campaigned on scaling back fossil fuels and galvanizing renewables. He also passed the largest ever fiscal commitment to climate through the Inflation Reduction Act. President Trump, on the other hand, he campaigned vigorously to support the traditional energy industry during his presidency. And how did this work out? So on this slide, what you're looking at is the gray line is the S&P 500 energy index, which is basically traditional energy. Then the green line is the global clean energy index. And if you look at that vertical dotted line, to the left of that line shows how each of these indexes performed over Trump's presidency. And on the right side of that line, how each of these indexes performed in the Biden administration. And the results were actually opposite of what you might expect. So under Trump, the S&P 500 energy index actually fell 40%, while the global clean energy index was up 275%. Yet under Biden, the S&P 500 energy index nearly doubled, while the clean energy index was down 50%. So kind of the key piece of this is ultimately it is macro forces such as supply and demand and interest rate environments, things like that, that drive performance more than any presidential policy does. Therefore, we can't really rely on policies to predict market returns. Now that's the end of the market portion. Dave, I'll turn it over to you.
You know, Matt, I love that last slide that you went over because I think there's so many misconceptions that we tend to have as investors. And certainly I know we get questions from clients and prospective clients all the time on this. And I think the really telling thing about that last slide is how policy decisions can actually have the opposite effect on equities, and that policy decisions impact very, very little as to what actually takes place with the markets, the economy, and returns. And I just love that last slide because it really gives us a great visual. So thank you to Drew and to Matt for all their insights. I had a ton of takeaways, and I think to sort of wrap everything up, there is a ton of misconceptions out there when it comes to elections, markets, and economies. again, reiterating the point there, policy decisions actually can have the opposite effect on equities. Leading up to an election, there's a lot of volatility. Certainly, we're starting to see some of that take place here. Volatility will definitely increase, but in most circumstances, they calm down post-elections, except for years where the economy's already been in a bad place, like the dot-com crash or the global financial crisis that we saw in 2000 and 2008. Political power really has little to no bearing on markets over the long haul. It's really best for investors to just stay the course. And the best performing markets actually are when we have divided governments, which the only political opinion that I think I'll share is a stalemate in DC actually it tends to have a positive effect on markets because no new laws get passed, and that generally is a good thing for markets. So stay tuned for more content on the economy and markets. As some of you all on this webinar know, we produce a quarterly economic update, as well as producing content weekly as to what's going on with markets. So stay tuned for more information on those areas. We actually have a few minutes left for Q&A. And so please, we got some great questions prior to the webinar starting. As you have additional questions, please use the Q&A box to submit your questions. So the first question that we have is, what plans have Instrumental Wealth? I think there might be a typo, but what plans does Instrumental Wealth have if either candidate wins? And do you have different plans? Matt, do you want to address that first question?
Sure. So I wouldn't say we have different plans depending on who wins. I think as we went through the office or went through the notes and everything else today, hopefully we made it fairly clear that the result of the election really isn't what you should be making your investment decision on. It'd be more macro factors. So for us, we really spend our time really trying to see what's going on with the economy, look at the different macro factors. When the election gets cleared up, we obviously some of their policies could impact how those macro factors move. That would be more impactful to what we decide to do in our portfolios, not the election itself.
Yeah. Thank you, Matt. Next question we have that was submitted was the probabilities of what's going to take place with the economy, depending on if there's a Democrat or a Republican in the White House. And I'll actually just probably tackle that one, which I think was somewhat discussed throughout the presentation. But I think to just reiterate the points that were made is it really has limited to no impact on the economy. It's quite interesting. We, of course, have clients that bring this up to us often, and political views we tend to not necessarily discuss in our client meetings so much, but ultimately it is a major concern for folks. And I think depending on what side of the aisle you sit on, while you might have a strong opinion one way or another, that the reality is both parties like to take credit for certain things and then blame the other party for things that don't go well. But it really has limited to no impact on the economy based on who's in power. And I think that's the sort of major piece here when we look at the data. So great question. So next question we have is, given the rise of prediction markets, will the market react differently this time? So I think the easy way to sort of unpack that is prediction markets are betting markets, no different than maybe if you go to Las Vegas and place a wager on who you think is going to win the Super Bowl or the college football national championship. They really don't have any tie to the stock market. It's a good way to kind of view where people are placing wagers. But again, it really has no impact on markets whatsoever. The next question we got was, what impact did COVID have on the market result? And so, I don't know if you want to tackle that one.
Sure. I mean, you saw a sharp decline in the markets, obviously with COVID and everything, as the world was just turned on its head there. But we also saw a dramatic recovery very, very quickly, very rapidly. Contrary to what happened in the great financial crisis, where it took the government a lot of time to respond and putting programs together, they responded much quicker, which really what that did was give the markets a chance to calm down and actually continue performing, because they were doing extremely well leading up to that. And so really, the supply chain issues have somewhat worked themselves through the system. So we're seeing that. Now there's still things that are outlaying issues that we still see, but the COVID markets, I mean, really rebounded quite handsomely. And we saw areas in the economy that actually did really well. People were stuck at home during that period of time across the nation, and different states had different rules around that. So you saw these pockets of explosions of growth and things like that as people started to become more aware of how they affect their own economy. And I think that's an important thing to really, we didn't talk about it too much here, but kind of how you handle your personal economy is much more indicative of your personal performance long term than the government, and not giving too much power to people that don't control your life. And so I think from that standpoint, I think as people got out and continued to be consumers and do things, there was recovery in markets. Markets were rewarded for that.
And if you don't mind, if I take that a little bit further as well, what we saw is, when we were in quarantine, there were certain sub areas of the markets that did very, very well, particularly with the work from home and things like Zoom or home workouts like Peloton and things like that did very, very well during quarantine. And then once we started coming out of quarantine, we actually saw a reversal of that. So many of those that were kind of the really hot areas of the markets just had just practically a big collapse after that, where other areas started to fill in the holes and do better. But in addition to the markets, probably some of the biggest impacts we had, which also affect markets, are on the economy, such as inflation. I mean, inflation really was probably the biggest impact of COVID and the quarantine, as we were all stuck at home. Once we started to be able to go back out in the economy, inflation just skyrocketed as demand went much, much higher than anybody had expected. Even the Fed and other central banks did not expect the demand that we had to at least continue as long as it did. And we saw that spike in inflation, which resulted in the Fed and their aggressive interest rate policy, which we've been dealing with as far as the markets go, looking at inflation, looking at interest rates, and all that have kind of had impacts on the markets. So that's what we've been paying attention a lot to. So that also was a big result of COVID as well.
Thank you. Thank you all for your attendance and participation and the great questions that came in. I want to thank Matt Harbert and Drew Allen for their input on today's webinar. And as always, if you have questions, feel free to reach out to your advisor, email, direct message us, whatever is easier for you. Also, please, I mentioned it earlier, but we do a quarterly focus and a webinar on the economy. So if there's specific econ questions that you have, please be paying attention for announcements for that. That generally comes out about 30 days after the end of the close of the quarter, so we can wait for the data to come in from the different sources that report on the economic data, as well as our weekly market commentary. So again, thank you all for attending, and look forward to the next time around. Have a great day, everyone.